Stocks clock some more gains led by mid-caps ahead of inflation prints and the US Fed meet outcome. Oil and gas as well as industrials, the big gainers today, even as realty and FMCG drag.
HCL Tech's 278 million deal win from Germany's largest cooperative bank raises hopes of a revival in BFSI spending, boosting IT stocks. The tech major also expands its ER&D engagement with Olympus.
Former Kotak Mahindra Bank Deputy MD KVS Manian and two executive directors with Federal Bank are likely to be on the CEO candidate list submitted by the bank to RBI, sources tell CNBC-TV18.
Morgan Stanley's Rhythm Desai tells CNBC-TV18 that emerging markets are not receiving foreign funds due to China. He also cites premium valuations in India as a deterrent, but expects foreign flows to pick up in the second half of the year. Hello and welcome to Halftime Report. I'm Ekta Batra, with me is Manglam Balu. Well, it is turning out to be a session which is showing steady gains for the market, and what really stands out is the broader markets. The mid-cap index is up another 1% The advanced decline ratio has been in positive terrain for the entire week. Let's see how today closes up. But as of now, the advanced decline ratio stands at a good gap between the advances and the declines, as it has been through the week, and stands at currently 2:1 on the Bombay Stock Exchange. Separately, besides the markets and the elections and the cabinet choices, all of that out of the way, we do have a lot to concentrate on in terms of events to watch. Today itself is going to be big because we have the Fed meet outcome. We have the US CPI data for the month of May, which is estimated at around 3.4%, and the India May CPI as well as the April IIP, which will be out this evening as well. So a whole host of cues to watch out for from the macros, and that's going to be quite determinant in terms of how we'd probably move in the next 2 days. Hi, Mangla.
Take that point, Ekta. Hi, Ekta. It's been a good move so far. Despite all the volatility, now continuity is what the street is backing, and we're back again at a record high. A little over 23,400 for the Nifty, just above 50,000 for the Nifty Bank. On a closing basis, over the last 7 trading sessions, Nifty Bank has closed above 50,000 just once. Will that continue in today's trading session or not itself is a question that we'll get an answer to in the next couple of hours. Important to hold above these levels for the market to sustain this up move that we're seeing, because we have seen signs of supply coming in at levels upwards of 23,400 for the Nifty and 50,000 for the Nifty Bank. Notwithstanding, we have the Nifty Bank weekly options expiry play out today as well. But a whole host of stocks are buzzing.
Yes, absolutely. Let's kick off the show with TVS Supply Chain. It's buzzing following a deal with Germany's Daimler Truck. Manglam, you're tracking this story. Tell us more.
Well, it's an important deal. Why is that? Because the company's announced a 5-year contract with Daimler Truck Southeast Asia Private Limited, which is, of course, a part of the overall Daimler Group. This will streamline supply chain operations for the company's Daimler Truck Southeast Asia distributor network, and this solidifies TVS Supply Chain's position as a primary logistics partner for Daimler Truck AG. The important part is that the deal value is undisclosed. It is a 5-year deal, but what we know is that this is a step in the right direction, because the management, when they joined us post their fourth quarter numbers, they did say that for integrated supply chain, they are looking at double-digit growth in this year. 10 to 12% comes in from new businesses, and at the same time, they will see sequential improvement in the margin. So it is, the talk being walked out here by TVS Supply Chain, and that is something that the street is appreciating. But also, we have to say that the underlying trend of the market is strong, and at the same time, all the other logistics stocks are actually doing quite well. So if you pull up names like Snowman Logistics, Container Corp, or even the other logistics listed players, you would see that there is an up move, general tendency of the street to believe that infra focus from the government would help this space as well, and GDP growth would help as well, and that is aiding the move that we're seeing in a lot of these logistics names.
Okay, a lot of the logistics names doing well. Some news on Lupin, so just watch out for that. They have signed a license and supply agreement with a company with regards to marketing of a particular drug in Vietnam as well as in Philippines. So just watch out for it. It is basically a oral contraceptive which they will be marketing in both of these countries, Vietnam as well as Philippines. That's Stock in Focus on account of that. But let's move on then onto a CNBC-TV18 exclusive. Federal Bank has shortlisted 3 candidates for the post of MD and CEO of the bank. They have sent the names to the Reserve Bank of India. Abhishek is here with the details on this.
Well, we had told in February that, the Federal Bank has shortlisted candidates for the post of MD and CEO of the bank, and that's the names, those are being sent to RBI as well. So it's been sent to RBI about 10-15 days back, and sources do tell us that KVS Manian, who is the ex-deputy MD was at Kotak Mahindra Bank, his name is likely to have been included in the list as the external candidate for the post of MD and CEO of Federal Bank. The likely internal candidates whose names have been sent are Shalini Warrior, who is the Executive Director, as well as Harsh Durga, who is the Executive Director. Now, as the external candidate, Mr. Manian's names bodes well due to the culture of South India being in reference over here. Just to alert our viewers, CNBC TV18 had reported in Feb that Manian could be in the race for this post, and we have written out to Federal Bank as well. They have not yet responded to our query. Back to you.
All right, Abhishek, thanks a lot for that. 3% move in the stock, taking it to a fresh 52-week high. Clarity on the leadership, the next rung of leadership will be extremely crucial for Federal Bank, and we'll await. RBI is not on this. Abhishek has picked up these names from his sources, but there are a lot of these industrial stocks which are moving around. We have CG Power, HAL, all of them trading in the green on the back of a positive note coming in from a bunch of brokerages. Vamakshi joins in with the details here. Vamakshi.
Well, absolutely, Mangalam. All of these counters surging anywhere between 1 to 4%. Let me first start off with Cummins. They had a management meet, and Goldman Sachs said that the company sounded quite positive on the overall domestic demand. However, this could be partly offset by weakness in exports. Real estate, railways, data centers, as well as construction equipment is expected to lead the demand as far as gensets are concerned. However, potential price discovery, especially from the new norms that are expected to come in from 1st of July, could impact the revenues a bit in their opinion. So overall, they've gone with a neutral rating on this stock with a target price of 1,940 per share. But on the other hand, Macquarie has an outperform rating on Cummins. They've given a target price of 3,975 per share. They believe that in the medium term, there are multiple growth levers that could hold appeal for Cummins. As far as some other industrial stocks are concerned, UBS has actually come out with a report, and they are expecting most of the policy initiatives that are in place to continue going ahead. In fact, they're expecting a 19% CAGR growth in orders, 18% each in top line as well as EBITDA for the entire coverage universe, and this is expected to continue over a period from FY24 to FY28. Largely, this will be led by momentum in urban infra, defense, mobility, as well as sustained private capex. Their top picks include CG Power, HAL and ABB. So overall, positive brokerage notes as well as commentary coming in from the managements of all of these companies, and as a result, all of these counters are surging in trade today.
Okay, all right, Vamakshi, thanks very much for that. Well, we need to take a short break with the news that the markets are extremely steady at this point in time. We have the Nifty, which is just about scale 23,400 as we speak, and the Bank Nifty, which is up above 50,000. We'll take a short break. On the other side, we'll bring you an exclusive conversation with Arvind Maya, who's the CEO of Embassy REIT, to discuss the 5-year journey of REITs in the listed space. Stay tuned.
This afternoon, we have a decent traction that we're seeing on Sun TV. Of course, there's a brokerage note that is coming in out there. A lot of long positions added. The other one that is, seeing an up move is Dish TV. That has been doing well all through the morning and now up around 11% as we speak. And HD Media too was in the red for a fair amount of the day and now eked out some gains and moved to the high point of trade as well. So that's one pack that we should keep on our radar. Of course, the first quarter numbers for a lot of these media stocks will be extremely strong, largely led by the increased ad revenues on account of the elections. But that's not the only stock or sector on our radar. We have the realty sector as well. In our special segment, REIT Connect, Nisha Poddar caught up with Arvind Maya, who's the CEO, Embassy REIT, to discuss the 5-year journey of REITs in the listed space.
Firstly, it's been 5 years. It's been a phenomenal journey. I think in terms of starting off on the regulations per se, starting with enabling the overall regulations with the regulator and then implementing it and then evolving the regulations based on what we saw in practice along with the regulators. It's been, I would say, a very educational journey for all of us, but it's very important at this stage to thank a lot of regulators for bringing this product to life in India, be it, of course, starting with SEBI, IRDA, Central Board of Direct Taxes, and Department of Economic Affairs. All of them have played a significant role in bringing this product to life. But just talking about REITs per se, you're aware REITs are supposed to be a stable asset class. But 1 year into the first REIT being in existence, we got kind of an existential question with COVID hitting us, and then of course leading to work from home. But 5 years later, or 4 years post COVID, I would say we've come out pretty strong, fundamentally for two reasons. One, India office is here to stay. We can speak about this a bit more subsequently. And second is because of the regulations itself. What I mean by that is, if you look at the REIT regulations, firstly, it clearly says that 80% of the assets have to be completed and rent generating. 49% is the maximum leverage we can take, and we cannot buy land, which basically means there's no speculation. All put together, it ends up being a very stable asset class. So 5 years later, where are we? We are 4 REITs, 3 commercial, 1 retail, owning about 115 million square feet. We've raised about 26,000 crores from the market and distributed almost 17,000 crores in the last 5 years. So it's been a pretty good start for us as a product.
Right, but it's still at a nascent stage as an asset class here, Arvind. And in other countries, like in the US as well as in Singapore, they are much more evolved and matured with many types of also real estate being rolled out as REIT. How do you see India compared to the other matured markets, and what could be the growth potential going forward for REIT as an asset class?
Yeah, you're absolutely spot on, Nisha. It's very early days for us. Why don't I take US as a case in point? Because that's probably the most evolved market for REITs, right? In US, close to 99% of REITs are in the form of listed commercial real estate, right? The total market capitalization for REITs in US is $1.3 trillion versus that number is only around $11 billion for us in India. And when you look at the type of REITs or the type of assets which are in the form of REITs, it's starting with, of course, commercial, retail, there is residential REITs, there is hospitality in the form of hotels, there is hospitals, there's data centers, there's industrial. So a lot of asset class which are already in the form of REITs, whereas in India, as you're aware, it's just 3 commercial and 1 retail. And also, just to speak a bit more on commercial, in US, there is about 4.8 billion square feet of commercial real estate, versus that number is only around 800 million square feet and growing pretty fast. So I would say the growth potential for this product in the country is very, very vast, and we've just started on a growth path as we speak.
That's right. And you mentioned about the various types of real estate also being part of it. But in India, we have one in which owns shopping malls, and the rest, the bulk of it really comes from office space. So let's talk about the potential, Arvind. What's the potential of this grade A office complexes, and in terms of growth, in terms of demand, as well as also the rentals increasing, which has a direct benefit for the investors of REIT?
Yeah. So talking about office, Nisha, the 3 commercial office REITs today own around 100 million square feet, versus the all India stock, as I said, is around 800 million square feet. But just to start with a few numbers first, over the last, if you see calendar year 23, we've done about 60 million square feet of gross absorption, around 40 million net. That number is expected to be around 65 million square feet for calendar year 24. And largely, this is coming from an unprecedented demand from global captives, right? So they are growing phenomenally in India. Again, to give you a few numbers on captives, today there's around 1,700 captives in India, expected to grow to around 2,500. They employ around 19 lakh people, expected again to grow to around 45 lakh people. And the interesting stat is close to 72% of global 500 companies as of today still don't have a captive presence in India. So all of these are coming to India. So the question is, why is commercial office growing in India? I would say broadly three reasons. Number one, the most fundamental being availability of talent at scale and at a reasonable cost. Now, if you want skill sets, people across different skill sets, you'll find it in India and at the scale which organizations want. So that's number one. Number two, I would say, is availability of world-class office space in India, like what you find globally. And probably the third important reason is the India as a country per se, right? We are seeing a phenomenal amount of growth as a country, stability in policy, a lot of investments in infrastructure, and of course, the focus on ease of doing business. All put together, I think these are, I would say, the catalysts for commercial office to grow, continue to grow in India.
Okay, well, talking about real estate, we do have Brigade Enterprises, which has come out with a press release. They are launching Brigade Icon Residences. They're looking to invest around 8,000 crores in Chennai as well. So some details coming in on Brigade and their plans there. That stock is down around 2.8%. Some more news coming in. We have Tata Communication, which has announced a 5-year host broadcasting deal with World Athletics. So that's stock in focus as well. We'll take a short break, but Jayesh Bhanushali will join in to discuss technicals on the other side. Stay tuned.
150 points on the Nifty, 300 points for the Nifty Bank, holding just above that 50,000 mark. The Nifty Bank is considerably off highs, and as a result of which, so is the Nifty. At one point, it was higher by almost 1%, and now it's shaved off some of those gains from the top. Understandable, but no real concerns for the market itself. From record highs, we've seen some bit of profit taking. The second half extremely crucial because we have the Nifty Bank weekly options expiry playing out in the second half, and it's the 50,000 mark which is extremely important for the Nifty Bank itself. So if you just take a look at the Nifty Bank options activity which is underway right now, it is at the 50,000 call and the put where most amount of action is. The 50,000 put has a premium of almost 100 odd rupees, and it's seeing a fair amount of writing now that the Nifty Bank is above that 50,000 mark. But at the same time, we are seeing an equal amount of writing on the 50,000 call as well. A combined premium of almost 200 rupees on that straddle, telling you that maybe the street is bracing itself for a range of 49,800 on the way down to about 50,200 on the way up, with some resistance around 50,100 itself, which is closer to today's high. On the Nifty itself, because the Nifty Bank is facing some supply here, while we're seeing some writing at the 23,300 put and the 23,400 put, important to know, while the support has moved higher, the resistance still continues at the 23,500 mark. There is equal amount of call writing. So the 23,500 call comes up for you, premium of 46 rupees, telling you that 23,550 thereabouts would be some resistance. Long positions added on a couple of names. We have Sun TV as well as Oracle Fin. Just keep an eye out on Z as well, because Z was one of those stocks that entered F&O ban on day one of the June series itself. Now the open interest has come down. It's around that 80% mark. If it falls below 80% in today's trading session, then the stock gets out of F&O ban.
Okay, all right, Manglam, thanks very much for that. So that's on the entire F&O space. Jayesh Bhanushali of IIFL Securities now joins in on the show to discuss the technicals with us. Jayesh, hi, welcome to the show. Well, it's definitely a lively market, more livelier for the broader markets. Let's start with your top picks today.
Basically, we would be recommending two stocks. First would be Keynes. Keynes Technologies revenue in the Q4 grew by roughly 75% year on year, led by strong execution across its industrial and A&D segments. Even the rebound was seen in EV orders, and strong acceleration was seen in multi-year contracts in its A&D space. Management has guided that for the FY25, 60% of revenue growth would be happening. Hence, we expect that the guidance of $1 billion of revenue growth by FY25 to actually come in play. We have raised our EPS estimates in gains by 10% for the next financial year. We expect the stock to head higher up to 4,000 rupees as well during the upcoming days. Hence, we recommend a buy on it. Since it's a fundamental call, we would not be having any stop loss, but 4,000 would be the target. Second call in terms of technical, we believe K Fintech could do pretty well in the coming days. The stock has rebounded from its 89-day exponential moving average. I believe it is currently hovering around 730 rupees. From here on, we could expect another 10% upside in the stock. Stop loss could be around 695 rupees. Above 775, it can even break out above its previous swing high too. So K Fintech would be a buy with a target of 800 and a stop loss of 695.
Okay, all right. Well, Jayesh, thanks very much for that. We're going to leave it on that note. Thanks very much for taking the time out, giving us those technical picks. We need to take a short break. But up next, we're going to be talking to Chetan Iyer, who's the Chief Asia Economist and Emerging Markets Morgan Stanley, to decode, will the new NDA government impact the India growth story? Stay tuned.
With the cabinet formation now out of the way, focus shifts to the union budget expected in July. Morgan Stanley believes that policymakers will stay on the current policy path of boosting private investment. They also believe that the supply side reforms will remain the best approach to maximizing social welfare. So to discuss this and more, we have with us Chetan Iyer, who's the Chief Asia Economist and Emerging Markets Morgan Stanley, joining in from the sidelines of the Morgan Stanley India Investment Forum. Also joining us on the show is Lata Venkatesh. Thanks a lot, Chetan, for joining in. You know, that really is the first question. The fact that a lot of people were worried that this general election outcome would, increase worries about increasing wealth redistribution, so to say, and maybe derail the path of infra development that we saw. Do you think that should be a fear now that most of the election outcome is out of the way? We have a lot of the key portfolios continuing, ministers continuing with their portfolios. And what's the way ahead?
No, we don't think so. So look, I think first of all, if you kind of look at the election results in more granularity, some of the states where we have seen big support for the ruling coalition reflects that it's not that there's a consistent message across the nation that poor people seem that things were not great for them in the last 5 years. So first of all, the message is not very clear to read. And that's evident that, if you think about the outcome in Orissa, in Madhya Pradesh and Bihar, you can sort of question the implication from some of the market commentary that we're hearing, that the message is that it has to go more towards, the government has to go more towards redistribution. So that's the first point. The more important point is that we did this analysis on how the bottom 20% have seen improvement in their real incomes in different 5-year election cycles. And we found that in 2009 to 14, as well as between 99 and 2004, real incomes for the bottom 20% was just about 1.3%. And of course, we saw that after that 5-year period, both of them, 99 to 2004 and 2009 to 14, the incumbent governments suffered in the political outcome. And so the message that we read from the data is that if there is loss of macro stability, you have high inflation, and you don't have enough of investment growth and job creation, that is actually adversarial for the politicians or the policymakers who are in power at that point of time. So with that message, we think that the government should continue to stay on the path of investing. achieve moderate to high real GDP growth, and keep inflation in moderate level. And that's what will ensure that the bottom 20% per capita income or the income growth will be strong enough and bring them back to power.
Chetan, that's an extremely well-argued paper, both the inequality numbers you quote as well as the election data. But the rhetoric seems to have been gained by the regime seems to be that they need to be pro-poor. The first file the Prime Minister signed was Kisan Samman Nidhi, and the first policy decision was expanding PM Awas Yojana. So, what they ought to do is what you are arguing. But is there a very strong likelihood that they will not do that, but they will follow a more redistributive policy?
So, first of all, Lata, I think, it's not as if in the preceding 5 years there was not any redistribution spending. If you look at revenue expenditure for state plus center combined, or even if you just want to look at the central government, revenue expenditure to GDP is relatively high. The central government still runs a meaningful revenue deficit. So there was spending on redistribution, and the announcement that we have heard are part of that revenue spending that was ongoing. I don't think this means that revenue deficit or revenue spending as a percent of GDP will rise. There can be some shift in allocation towards housing, as they have already announced, away from something else. But the key question that we need to answer is that, is there going to be compromise on revenue deficit and revenue expenditure in aggregate away from that allocation towards capital expenditure? As you can see, the capital expenditure as percent of GDP for the central government has been going up quite nicely, and now it's at a 20-year high. Whether that kind of reverses, my answer would be that that will not reverse. Because of the big picture that I explained, that they understand that this is actually not going to help their political outcomes, because if you don't take care of the bottom 20% by keeping inflation low, then that is going to backfire. So I think both from the economics management perspective, as well as I think the political objectives of protecting the bottom 20%, it doesn't make sense to take any measure that eventually results into higher inflation. And let's for one moment assume that they've taken the wrong message, i.e. that they're not looking at my research paper and arguments, but they're just somehow following this rhetoric which has come up in the media that they need to do more redistribution spending. The question is, why do it now? If you do it now, then you're going to have inflation in the next 2-3 years. That would not work out well for them. So even if they want to do it, ideally it would be done in the 4th or the 5th year, but in the next 2-3 years, we wouldn't really expect much.
Okay. Well, so your base case is that this year it will be a 5.1% fiscal deficit. Or are you even expecting less?
No, I think it should be around 5, and that will give them some more leeway to do more capital spending and infrastructure spending. And of course, there will be that revenue spending, which is not gone down to zero, or revenue deficit is already not down to zero. That will be maintained, and that some amount of redistribution spending will be there. But I don't see a major reversal in that fiscal consolidation trajectory or revenue deficit reduction trajectory.
Okay. Chetan, what about tougher reforms such as the land and labour reforms? Are you factoring that in at all in this in the next 4 to 5 years?
We are not. So we thought that if there was a strong mandate, they would have taken the plunge into trying out and taking up tougher reforms on. I think the labor part is more critical. The land part is still less critical. The labor part would be critical because the model for India going forward, or sustainable growth model, would be that you focus on improving productivity in farm, release that farm labor to then migrate to urban India. And for that, you just need that flexibility in the labor market for small and medium enterprises to be able to absorb this migrant workers coming in from rural India. But, the laws are still a bit too stringent for the SME and the medium-sized sectors. The large corporations are fine. They are probably employing some workers on contract basis and managing the labor laws. But it's for the small and medium enterprises where they do need to implement labor reforms. But look, I think that would help to get growth to go to 8 to 10%, which would be ideal because then that will take care of the increase in workforce that we see every year. But in our base case, we are assuming about a 6.5% real GDP growth over the medium term. And in that, we are not assuming any big reforms on land and labor.
Actually, that was the number that confused me. Why 6.5, Chetan? Look at the last 3 years, 9% in FY22, FY23 was 7.25% or 7.2, and the latest year it has been upped to 8.2%. What's your current year's forecast, and why are you not expecting at least a 7% plus growth in the medium term?
So, Lata, I think the recent years' numbers, you have to think about it that there is a significant base effect because we went down meaningfully in 2020 and then we have been building it back. So if you look at, 4-year or a 5-year CAGR basis or compound annual average run rate, then that growth rate is still not in line with what we should have been based on pre-COVID path. So I think there's a base effect that has been building on and helping us to grow at a strong rate. And the very last financial year, we all know that there were some adjustments on the account of indirect taxes and subsidies. But if you look at GVA, GVA growth is in the last quarter at 6.3%. So I think that, if you just take the underlying growth rates based on GVA, it looks like, something like 6.5 to 7% seems more reasonable. And therefore, we are kind of building in that kind of assumption of 6.5% growth rates.
Chetan, every expert that we speak to says that unlocking productivity of the farmland will be one of those things that will unshackle growth for us. But then again, we saw what happened the last time around this was tried. So is there any possibility of assigning a non-zero probability to an event like this?
Is there a possibility that they might take something up to improve farm productivity aggressively?
Yep.
Well, I think there is a possibility, but I think that, you saw that one of the things that they need to do is to allow more corporate farming and ability of farmers to sell directly to the corporate sector. And that was a reform that was being planned, but didn't get didn't get implemented. So I think there's still possibility that they may try it again. It's just a question in this political environment whether they will be able to do it. And at this point of time, we are not building it in our forecast.
What are the big sectors you will watch out for in the upcoming budget?
I think it still has to be either investment line. I think if you just look at India's investment to GDP, it has started to go up from the bottom of about 29%. It's right now around 30 to 33% of GDP. In our view, to ensure that GDP grows at 6.5–7% sustainably without having macro stability risks, you need the growth story to be driven by investment. And even when we are talking about the trickle-down effect and the job creation needs, it is always in sync with what happens to the investment line. So I don't think that the government deviates from it. There might be, of course, probably a bit of a change in their approach in terms of how they market their budget spending, and whatever revenue spending that they're doing, they might probably emphasize it more. But they can't lose the sight of the fact that you do need that investment to GDP to go up. So I would sort of build in for the next 5 years investment growth to outperform consumption growth. And within consumption segment, we are building in urban consumption growth outperforming rural consumption growth.
We are meeting you before the FOMC, so I have to ask you this. When is the first cut from the FOMC and when is the first cut from RBI?
So for FOMC, we are assuming that they will begin to cut rates from September meeting onwards. That's on September 17th. And that's premised on the fact that we expect that the next 4 inflation prints will be implying that core PCE number, or personal consumption expenditure deflator, will be around 0.2% month on month, which would be annualized run rate of 2.4. And that would give the confidence to the Fed that we are now consistently achieving numbers which are below 2.5% on a sequential basis. And that's how they begin to cut rates from September. Okay. As far as RBI is concerned, we have taken out our rate cuts about 2 to 3 months back. And our framework on that one is that you have seen this pick up in investment to GDP and productivity growth, and that the real neutral rates are higher than what was perceived to be in 2022 when RBI had published this research paper talking about a 80 to 100 basis points real interest rates. We think now real rates should be assumed to be more closer to, or neutral real rate should be assumed to be more closer to 2%. And we're expecting inflation to go down to 4.5%, policy rates stay at 6.5% with 200 basis points of real neutral rates. The other thing is that, that paper which Dr. Patra had published in 2022 did mention that if you do have a leverage cycle and asset prices are rising, real neutral rates will be higher. And maybe the next monthly bulletin where they are going to talk about this will probably emphasize on that and indicate the market that real neutral rates need to be higher. And then just one final point on that, Lata, is that, you have credit growth at 16.5% and deposit growth is at 13%. How does RBI sort of give a message to the banking system that, let me add some fuel to the fire, you accelerate credit growth, and guess what? I'm cutting policy rates, you cut deposit rate, even if you don't have your deposit growth matching credit growth. So that seems difficult for RBI to do, I think.
Okay, all right, Chetan, we're going to leave it on that note. A lot more questions, but completely run out of time. Thanks very much for joining in and speaking with us and talking about your outlook on the post-election scenario in India, as well as the FOMC and the RBI. We'll take a short break. We'll get you a lot more on the markets once we're back. Stay tuned. Welcome back. Well, steady for the markets. We have a couple of stocks which are gaining. So just watch out for a couple of these hospital counters. Max Healthcare is up around 5.5% at this point. It's gained significantly. So year to date, Max Healthcare has picked up around 20%. We have a couple of others such as Central Bank of India from the entire PSU space is gaining. So that stock is up around 4%. It's gained around 33% this year. And even a couple of other stocks which stand out is something like a Reliance Power, which is up around 10%. Huge amount of volume and price action on that one. It's around 31.5 odd rupees. And you're seeing a good amount of traction which is taking place there. Trident, which is up around 6 odd%. And a couple of others on the upside. Brigade Enterprises, despite some positive news coming in, there's some profit booking taking place. So that stock has extended its losses. It's now down around 3.5 odd%. But remember that the stock has run up around 50% this year, so maybe that's warranted there. And a couple of others on the downside include a couple of these diagnostic companies, Metropolis, Dr. Lal's, both of those stocks down around 2 odd%. Interglobe, which has been a rank outperformer, is down around 1.5% as well. But we now have Manisha joining in to talk about the commodity space. Manisha.
Thank you so much for that, Ekta. And joining me on the show is Colin Shah. He's MD Kama Jewelry. Colin, thank you so much for joining us. And I, first of all, want your reaction onto the DGFT notification that came in last night. And this is about import of jewelry and 5 HSN codes which have been put out in the DGFT notification. We do understand that the CEPA with UAE stands tall. It is about the least developed countries perhaps South African countries, Indonesia, Tanzania for that matter, which really could be in, is what the DGFT is talking about here. But my sense is we did see a huge surge in sense of jewelry imports from many of these countries. How do you see, one, the impact of this, and how do you see the pricing within country with this?
Thanks, Manisha. So the DGFT notification yesterday is mainly, I would say, correcting an error which was maybe there in the earlier agreements. So, we were never meant to, I would say, import plain gold jewelry, especially from Indonesia or Tanzania, which was basically the jewelry was coming to India, being melted, and then utilized for, the obvious duty benefit, which obviously puts, say, most manufacturers and retailers in India at a disadvantage on pricing. So I guess the notification is a welcome change, and it will correct that anomaly of imports which were coming in from both these countries. As far as the India-UAE FTA is concerned, that stays in place, and we are really hoping as industry that it only gets strengthened further because it will really help boost exports from India.
Since you have spoken about exports as well, Colin, and if you look at the first quarter or even as the last couple of months of the new financial year, the numbers in sense of exports haven't been so strong. Barring gold jewelry or plain gold jewelry, that is, everything else seems to have seen a bit of a decline and not exactly a growth quarter on quarter or even year on year, that matter.
This year will be a challenging year for exports. I mean, our main markets, US and China, continue to be in turmoil. Last quarter, even in the US, because of all this, I would say the industry is going through a transition phase, especially when it comes to the confusion between natural and lab grown and where both will land up in a year or a couple of years from now. So that is making, I would say, the retailers a little nervous globally. But having said that, I guess there will be more clarity coming towards the end of the year, where I guess the retailers and consumers will be either on the natural side or the lab-grown side. And as soon as that clarity emerges in a very positive way, I would say, for both sectors, I guess both will, again, flourish maybe in the 2-3 years. But having said that, on the India front specifically, and, we're thankful that finally election has come to an end. There's a new government in place. We are very happy as industry that we have the same commerce and finance minister. So there's continuity as far as policy is concerned. And what the industry anxiously needs now is the new SEZ Act. Because as soon as the new SEZ Act comes in place, a lot of policy issues which exporters are facing in our industry and other industries in the SEZ will get resolved, which will give a boost, especially in times like this when exports to begin with is challenging in the global scenario.
Well, Colin, that exactly was going to be my next question on what are your expectations from the new government. And as you said, the SEZ Act is something that you look forward to. Is there a timeline that you think, is there a particular clause or a point that you think should be included within the Act as well?
See, in the Act, the two main, I would say, asks of the industry has been for some time now, which is reverse job work and, ease of transferring property. So if these two are taken care of, besides, of course, I won't get into, several other smaller issues, but the SEZ Act, as you know, it's an act of parliament, and it was done many years back. Now, obviously, industry has evolved, the whole world has changed from AI to, and I guess the act hasn't followed suit with what the industry globally has changed to. So I guess a new act is much desired. And especially it needs to take care of the few, challenges which industry has been facing historically since many years. So that's one part of it. Second is asked from the budget very clearly, and they continue to be, more or less the same. But we are really hoping that with this fiscal space that the government has today, if something can be done on the duty of, metals, especially gold, platinum. Because with these high duties, smuggling has gone up. It continues to go up. And, then we have issues with FTAs and various other challenges which industry faces. And especially in a time when India has gotten organized, if you see more and more retailers are getting listed, which is a welcome scenario even from, the government's point of view, because we're going to have much more data on, say, our industry, which we never had historically, except for, you had a few listed companies. So now if the industry is putting in so much effort to getting organized, being compliant, all marking, GST, this huge anomaly on duty is causing a distortion between the organized trade and the unorganized trade. So if duties are reduced to a rational, I guess, era where it used to be earlier, the smuggling would stop, and it will help the consumer in India first because there'll be a cost benefit. And believe it or not, in spite of, the stock market going up tremendously and huge amounts of other avenues of investment opening up, gold continues to stay a safe haven globally.
It does, and we've seen that.
Gold run.
And yes, we've seen that in percentage terms as well. Even as the equity markets continue to make all-time high, it clearly has been a portfolio diversifier and stronger gains continuing in gold. Colin, a final question, and this one is on the Indian markets itself. We've spoken about imports and exports, but within the domestic markets, what kind of demand scenarios are opening up now? Because the first quarter was slightly weak. Second quarter, we saw Akshaya Tritiya coming in. By the time we are into third quarter, do you see festival demand picking up, or do you think, as you said, the exports could be challenging, but are the domestic markets keeping you glad?
See, if you look at the financial year, the first quarter every year generally, because of Akshaya Tritiya, is strong. But this year, due to election season, it did not have, I guess, the demand that it should have seen. Okay, so the first quarter was quite soft for retail across India. July, August, September quarter is always soft due to monsoon, Shraddh, not so many good days. The industry actually kicks off only from Raksha Bandhan and Ganesh Chaturthi, and then onwards, right? That's when the auspicious days start, auspicious season starts, wedding season, it's the beginning, okay? So what the industry expects this year is that October to March will be very strong. Everyone's thankful that, there's a stable government, again in the center. There'll be continuity. The first 100 days, everyone's expecting a lot, right? And if, there is some amount of delivery on the ground on all the promises, then I think industry, there will be a little buoyant mood come October to March. So what the industry expects is that in October to March, they'll have to make up for the loss of April, May, June, plus have growth.
All right. So we are looking at positive numbers going through. I get your point with the fact that the same government continues and the continuity in sense of reforms would also be there. So that is something that the industry clearly seems to be cheering on. Colin, as always, thank you so much for joining us for a detailed understanding on what really does the latest DGFT notification mean and also what the government formation means for the sector. But with that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action forward.